Hello, I'm Julie Zellman Davis with the SEC's Office of the Advocate for Small Business Capital Formation, and I'm so excited to be continuing our Let's Talk Small Business series with our today's guest, Jeff Solomon, the president of TD Cowen. And I need to quickly give the SEC's standard disclaimer that everything I say today is on my own behalf for my position here in the SEC Small Business Advocacy Office and does not necessarily reflect the views of the Commission, the commissioners, or my colleagues on the staff. So with that out of the way, Jeff, hello.
It's good to see you, Julie.
It's good to see you too. Do you want to start by just introducing yourself and telling us about who you are and how you came to work where you are?
Yeah, so it's it's not a special story, it's just my story. So
that makes it special.
Well, I was born and raised in Pittsburgh, Pennsylvania, and I am the product of a small business. My father was in the steel industry, and in 1978, he and his partner mortgaged everything they had and bought a small business that was the metal fabricating business. And for 40 plus years, they ran that business, as a small business, selling into big companies like Lowe's and Home Depot and a bunch of other folks. And, to say that the formative years as I was coming of age in the late 70s and early 80s, very difficult time economically in America, very difficult time in manufacturing. Kitchen table economics was a real thing. We'd sit down at the end of the day, and there were some seriously tough times with double-digit inflation, and in Pittsburgh at the time, double-digit unemployment. And so I was pretty sure of a couple things as a kid. One was I didn't want to work in that business. Two, I didn't think there was going to be a lot of opportunity for me to stay in Pittsburgh. And so I went to school in Philadelphia, and where I did a lot of acting and theater and singing and dancing. And I moved to New York ostensibly to become an actor. I wanted to be on Broadway.
I did not know that.
Yes. And, but I thought, if this whole acting thing doesn't work out, I should probably have a critical skill. So I got a job on Wall Street as an investment banking analyst. And I think it was a 2-year commitment. I'm like, I can do anything for 2 years. And I learned a lot, and it was fun. It was stressful, a lot of long nights, a lot of long hours, but I did it, and I learned a lot. And then I decided to quit and become an actor, which I did. But the former chairman and CEO of my company, I was pitching him on a deal idea in the hopes that I wouldn't have to wait tables. My big idea was I get him to do this real estate deal, I get paid a fee, and then I don't have to wait tables. But instead of doing the deal, he offered me a job, and that man was TD Cowen. And he and I became partners. We worked together for the next 28 years. So, yeah, kind of a wild story, but managed a hedge fund for a while. And then we bought Cowen in 2009 after the global financial crisis. And it was a wonderful opportunity for me to help engineer a turnaround and figure out how we could win in a different and much more crowded marketplace. And but it was all about being able to finance small businesses, in particular in the public markets. There's an exercise that of really trying to figure out how to make our way in a very difficult environment with lots of bigger competitors. And so we were small business ourselves for a lot of that period of time. And my passion for small business starts with my parents, and really has been a big theme in my life.
Well, that is, I know that because, Jeff and I first met in 2019 when you were on the commission appointed you to the Small Business Capital Formation Advisory Committee. And as committee vice chair, you always brought such thoughtful insights just from a variety of perspectives. And one thing I remember most particularly fondly is you always spoke with such a vibrant passion about our public markets and the importance of, how important it is to the U.S. that we have a strong IPO market. So I know you're no longer on the committee, so I don't get to see you quarterly, but I'd still love to open it up for you to wax eloquently on the importance of those markets.
Well, I mean, you're nice to say that. I've said this like that. Those times when we were forming the committee, and you and Martha and Carla and a few others, Sebastian and a bunch of other folks, Jenny, we would literally sit around and figure out, okay, how are we going to actually work in concert with one another to figure out what are the priorities, and then how can we actually do something that's actionable. And I've said, a lot of people have a lot of views on government and what the government does. And my view of our committee and the group that we engaged with, your team, I would tell people all the time, if you want to see the benevolence of government, you need to come and watch one of our meetings, which are publicly available. It's real people who want to do real good things for other people in this country, and figuring out how we can marshal the great resources that we have in this country for bettering and help. And really, this is the interesting, helping people to help themselves. Like, that's such a strong message about this committee. You know, we're not figuring it all out for small business and doing handouts. That's not what this is. What this is listening to small businesses and the challenges that they face, and then figuring out how to take the regulations and the enablement factors that we had at the FCC and put them to work to help small businesses to succeed. Sometimes that was in the public markets, but oftentimes it wasn't. And from my standpoint, yes, we did a lot in the public markets, but I felt like public markets are important not only for those that want to access them. We can talk about the benefits of public markets, but healthy public markets attract capital into the United States or keep capital here. And some of that capital goes into private markets. And we've seen massive growth in the private markets in the last 20 years. And the growth in the private markets is equally important. And so you need healthy public markets in order to have healthy private markets. And so the knock-on effect of having more companies have availability of public capital enables more companies to raise capital privately. And that's where you get innovation and where you get small businesses that really drive the backbone of our economic engine here in America. And so I was happy to do it. You know, some of the things benefited us at Cowen, to be fair, but the vast majority of what we worked on just was about helping, you know, real people get real things done, making their lives easier. And that's what I love that's what I love about the office. And that's what I love about our committee.
Well, thank you. I wasn't trying to tee up an infomercial for our office, but I do appreciate it. We love working with you. And at this point, I may just give a shameless plug for our office's annual report, which we put out yearly. Folks can find it on sec.gov, publicly available. But the report has detailed data on what's happening with capital raising across the country, from early stage private companies all the way to smaller public companies and new IPOs and what's happening there. So, Jeff, I know you know this, but for multiple years in a row, that report has shown that the number of small exchange listed companies has declined. So I'd love to hear, does that trend concern you? And do you foresee opportunities for change as you look ahead?
Well, yeah, that's actually how I started getting involved in things in Washington, D.C. Again, I was on the buy side for a long time, which means I invested capital, and I was in the alternative space, which meant that we were financing companies, but oftentimes we were just trading in secondary markets or doing arbitrage activity. So I really wasn't, for the most part of my time on the buy side, really plugged in what was happening to equity market structure and what was happening in investment banking. When we bought Cowen, I became acutely aware. Cowen has a legacy of research and sales and trading and equities and raising money for small companies. Like, that's the ethos at Cowen, and it remains a big part of what we do at TD Cowen today. But that mechanism of transmitting capital from investors to companies seemed broken after the global financial crisis, and certainly in the equity markets it was broken, as you saw a real precipitous drop off in the number of IPOs. But even before that, right, if you look at the 2000s, there was a meaningful decline in the number of listings from the heydays of the first internet run, like Internet 1.0 in the mid 90s to late 90s, until the end of, call it 2008, you'd see a meaningful drop off. And there's a whole host of reasons for that. We don't need to go through all those, but there were some structural impediments that made it very difficult for small businesses to actually garner the resources to go public. It's expensive to be public, right? The regulations are greater. Capital raising, there's a minimum threshold that you need to do in order to make it worth your while, because it's expensive to raise money with lawyers and bankers, and it's expensive to do this. And so it's expensive to be able to do Sarbanes-Oxley reporting and things like that. So we worked, a bunch of us worked very carefully in the early part of the 2010s and 2011 and into the beginning of 2012 to get the Jobs Act done. And the Jobs Act was really a critical linchpin. It was a great piece of bipartisan legislation that came out of Congress. It was signed by President Obama that allowed for there to be a different set of rules that for smaller businesses, emerging growth companies. This allowed them to do things like Title I was really important, allowed those small businesses to test the waters and ask investors if their businesses in the could be public, and if they were public, get a sense for where that valuation could be. Allowed for there to be a relaxation of Sarbanes-Oxley reporting, which brought down the cost associated with listing, and so you got to do these things that basically made it, if you were going to go public and spend all the money to do that, you had a higher probability of it actually working. That changed the dynamic for a lot of companies. And I was pretty amazed at how quickly we could get around that in Washington, actually. Like, everybody cheers for small businesses in Washington. It's one of the things that doesn't matter if you're Republican or Democrat.
That's right.
Almost all of us have family members that are in small businesses. And so when you show up on Capitol Hill, no matter how difficult of an environment is, you say, I'm here to talk about small business. Everybody wants to talk to you.
Yep.
And they're open to ideas for how can we make it better for small businesses. And so this is an opportunity. The creation of this office in 2016, great piece of legislation that came from Congress. Our ability to get around it, you can see, like, in a Democratic Congress it gets created, but in the first Trump administration is when we really started to do our work under Jay Clayton's chairmanship. It's not a Republican or a Democrat thing. It's just a thing that everyone wants to help. And I think for me, it's just being in a position where I can help to influence outcomes that make it easier for small businesses, both public and private, to raise money to build their own version of whatever the American dream is. And this is it, really critical, to allow more people to participate in capital formation as investors is a big part of this, right? People talk about the wealth gap and they talk about all these things, and the reality is that a lot of what we do in our markets only enables people like me and you to participate because we have knowledge qualifiers or because we have liquid net worths or earning capabilities that put us in accredited investor status. The vast majority of Americans don't even know what that means. And so one of the things I loved about our committee when we were really active between 2016 and 2020 is we worked really hard to make it easier for investors to participate. We still provided them safety and soundness, right? We needed to make sure that investor protection was at the forefront. But as we thought about different ways to protect investors, we're encouraging them to get more involved in their businesses regionally, locally, through private investment and maybe public investment. And that's just something I think we need to continue to refine and reiterate. It was a great part of what we did in the 5 years that I was on the committee. And I know that your office continues to do great work in that regard.
Well, thank you. And I'll just second what you said about, small business being nonpartisan. I've been in this office since it was stood up in 2019, and that's been under, two chairmen, two acting chairmen. And at every point, we've received nothing but total support from all of our commissioners for, engaging with small businesses and bringing in that feedback. And I actually want to take it back to the public market, since that's, where your expertise, well, you have a lot of expertise, but that's where you practice and work. But one of the things we hear a lot in that outreach is that the lack of research coverage is a significant problem for smaller public companies. So I'd love to hear if you also see that being the case. And maybe as part of your answer, you can talk to our audience and give a little explanation of the roles that those analysts and research coverage play in supporting public companies and why you think those elements are so important for investors and the companies in our markets.
Yeah, I mean, I'll just say there's a whole host of reasons why research has been challenged in Wall Street, and some of it's for good reason, to be honest. Like if you look at the global research settlement from 25 years ago, when a lot of stuff was going on Wall Street that honestly, research analysts were not independent at that point. And you had a lot of research analysts at that point that were shilling for investment bankers. And that did not end up well for companies like WorldCom and Adelphia and things like that. Like that was bad stuff. And Enron and right around then, and so there were some elements of the research global research settlement that were incredibly valid, and we needed to clean up. So now that we have a framework where we have research independence, it actually makes the value of research greater because organizations like ours have to protect that research independence. There's all these rules about how much the research analysts can engage with their bankers, and we actually have to chaperone with a compliance person every conversation between a research analyst and a banker, so that we can ensure that bankers aren't influencing research to say and do things that they want. in order to win deals. Like, it's a big thing.
Yep.
Figuring that out has actually been something that we've done really well at Cowen. It's been something that we, I think, focused on. How do you do high quality research? The reality is, though, if you're doing high quality independent research, you need trading volumes and commissions in order to pay for that. And the vast majority of trading volumes and commissions occur in very large capitalization stocks, right? We talk about the Fab Seven, right? Like, so much of the trading volume just happens in those top 7 stocks, and so you have to write a lot of research in order to be relevant to the institutional market in those stocks. And a lot of retail players, play those stocks too. And we're right on up there. You don't get a lot of banking business from those. You don't raise a lot of money for those companies because they've already raised money. So the dichotomy is, and I think the challenge is, we have to write high quality independent research, and the vast majority of the money that we make from trading happens in big cap. How much of those profits can we spend investing in small cap coverage in the hopes that we can help companies to raise capital while we maintain our independence? The model that's worked the best is biotech. And biotech has worked well because it's a complicated industry and it's difficult to invest in that industry. And so you need really experts in small capital. You also are raising relatively small amounts of money, 100 million, 150 million in an IPO, in order to do clinical trials. And you need experts like research analysts to be able to drive outcomes and opine on whether or not these things are going to work. That ecosystem has benefited probably the most of any ecosystem from the Jobs Act. And I've said this over and over again, Julie, you've heard me say it. There would not have been a vaccine without the Jobs Act. Now, that's not to say I'm not going to get into vaccine politics. I'll just say, for those that felt that they benefited from having a vaccine to deal with COVID, the technology behind that vaccine was created by small biotech companies that had access to private funding and then public funding. So BioNTech, which worked with Pfizer, Moderna, right? Those 2 companies raised billions of dollars privately because they knew they could get public. And that technology, when they were doing that in the teens, we did not know that technology was going to someday need to be used to come up with a vaccine. That is a great example of what happens when you have innovative small companies that access to capital. They begin to create amazing products and they take technology and they commercialize it in ways you can't possibly imagine. That is very similar to like NVIDIA when it was smaller, AMD when it was smaller, Intel when it was smaller. These are cornerstones of the American economy and the technology economy. Almost all of those companies had access to private capital and then public capital. And what we're trying to do is ensure, through increased research and identifying who are going to be the next versions of those, like when Amazon was little, did anyone know it was going to be Amazon? No, but you covered it as an interesting small company that became a really large company. And we think there's plenty of opportunities out there to continue to do that. So it's important to continue to have research identifying who are going to be the future Amazons and the future NVIDIAs of the world. Like, that's what we do.
Awesome. I love it. Well, and I also appreciate your explanation of the background and the history, because I'll just say, if you ever decide to change careers, you could be a professor. My parents were professors. I wouldn't recommend it, but
funny. I was talking with my dad last night, and he said, have you ever thought about doing like teaching and being a professor? And I'm like, really? I mean, no, but I can certainly see. It's like being on stage, it's like being an actor.
So there you go. You could bring it all full circle. Well, I want to just quickly put in a plug for our office's educational resources, which are also available on sec.gov. Jeff mentioned emerging growth company. We talk about, various different terms that I think a lot of folks in your world already know. And then there's always going to be terms that folks don't know, right? We have a glossary on our website. We have 25 different, we call them building blocks. They're one-pagers, and they're not just for early stage startup, public or private companies. We do have a lot of those, but we also have resources for companies that are looking to go public. So those ones you're talking about that may be thinking about, making that leap, we have a one-pager on, what's a balance sheet, or how do I know when I'm ready to take my company public? So I'm just going to put in a plug for that. I hope folks will check it out.
Well, can I also say this, because this is like, so this is this committee and that I was on, and your office is it's like a very three-dimensional office, meaning it's not only thinking about regulation and how and rules around investing, but it's thinking about how to enable small businesses to access capital, and how do you go about that process. There was this wonderful process that went on while we were at the SEC, while I was on this committee, called harmonization. It was working directly with the corporation finance folks to streamline the different and complex ways that small businesses can raise money and investors can participate. And when you think about that, we had a strong voice with corporation finance in streamlining and making it easier. So when small businesses say, I want to raise money in a small increment, whatever that is, where do I start? Like, how do I even know who to call, right? If I just want to raise it by myself, I don't want to hire an advisor, I just want to do it. Like, what does that even look like? What are the rules around that? And you should, if you're watching this and you're a small business and you'd like to go raise third-party capital, the first person you call is probably your lawyer, right? Because there's all these rules and lawyers are good at that. I would encourage you, go to the website, at least read through the different ways that you can do it. You're going to end up with a lawyer anyway, because it's going to have to be paper, but think about the amount of money you're going to save by having a knowledge over the process. And that's all free. That's why I say it's a three-dimensional office. It's there to literally say, if you want to raise money, debt or equity, here are the first steps and the second steps. That's what I love about this. This is why it's so fulfilling to be associated with the office.
Well, I appreciate that. I find it very fulfilling as well, because, we do hear a lot from folks like, I want to start, but it's so complex. The jargon is mystifying. And so some of the things we're doing are to, try to demystify the existing rules. And then we're also bringing in that feedback to, help facilitate where there may need to be changes to make them, make the rules work better for folks. So I'm going to, one last question for you, and then I know your time is limited. But are there, you're such a good, big out of the box thinker. Do you have, and you've talked today about, early stage private companies all the way to public companies. Do you have any more solutions or suggestions for ways that things could be better? Because, to help address the challenges that companies have accessing capital.
Yeah, I mean, there's so many. I'll pick one. We spent a lot of time on
question,
this.
Sorry.
It's not my time it's limited. It's everybody who's watching, and their time is limited. Let's be really clear.
But if you have the perfect answer, they'll be so glad they stuck around.
Well, here's what I would say. This is a great way to think about this for everybody. A lot of the rules that were written in 1933, and then all of the amendments to the 33 Act that established the SEC, and all the rulemaking that's gone on, it's all within this idea of safety and soundness, investor protection and capital formation, the three pillars of the SEC. The challenge is, of course, once you make a rule and you establish that rule based on size of the investor or the size of the investment, it's almost it becomes outmoded very quickly, simply because numbers get bigger, right, over time. Inflation, market capitalizations grow. There's a bunch of things that happen, and then you're stuck with a regulation that's stuck in that pristine time in which it was created. What that's done is the market for equities has just gotten enormous. The players in that market have pivoted from individual investors, which is primarily the way people invested in stocks in the 50s and 60s and 70s and early 80s, to institutional investors like the hedge funds and mutual funds and pension funds of the 90s, 2000s, and 2010s. And those players are very, 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 very large. As a result, they have to make big investments, and they don't have time to spend as much time to spend on small investments, because even if a small investment does well, if you're managing a really large amount of money, it doesn't move the needle for you. So at the surface of it, you have to only spend time on things that will move the needle for you if they're in this big institutional market. What I would love to see us do is bring back the individual investor in both private markets and public markets. So we do have onboards for direct investing, right? You have all the direct investment folks, the discount brokers and things like that allow people to buy individual stocks, but by and large, they're not doing that. They're buying managed product. They're buying mutual funds, right? And maybe they should be, to be honest. Like I'm not here. But that makes it much more difficult for smaller companies, because smaller companies rely on smaller investors and individual investors to actually do their money raising. What I would love to see happen, even before you get to the public markets, I'd love to see us open up the opportunity for more Americans to participate in private investments. Now, there's a lot about that, and we have to figure out how to do that in a way so that people are educated, that we have to do it in a way where we can observe it, so that if there's bad actors, we can go after them. Like, there's a bunch of more risk in private companies, especially smaller ones, than in large public companies. But if we don't figure out how to do that, the smaller companies will continue to not have access to the right kinds of investors who are likely to invest in them. And most Americans will miss out on the wealth creation that comes along with small companies that grow to be very giant companies. And we can debate all of the different opportunities and risks, and we should. Over the next 4 years, I would love to see the SEC, and I'd love to this office to take a lead in that, in helping to frame what would that look like? What should that look like? And take tons of information from the market, from investors and from companies on what they would prefer to see. And if we can figure out over the next few years a way to have more Americans participate in capital formation in their personal accounts, even with the failures that will invariably occur, there will also be winners. And that is how we can begin to perpetuate the system that enables us to be the greatest country in the world, right? Truth. And so that's where I would love to see it. There's no magic bullet. It's about getting the right people around the table who care about investor protection, safety and soundness, and capital formation, getting the three of those to work together to make more Americans, to make the markets more available for more Americans.
Well, I appreciate that. And I will just say, for anyone who's listening who has an idea like Jeff's, either support or a different idea, email us at smallbusiness@sec.gov, or when there's proposals out, we have a video on how to comment. And, I think folks think, oh, a comment letter to the SEC, that's written by a lawyer and it's multiple pages with footnotes. It doesn't have to be an email. We get emails, for the comment file that say, my company has found this to be an issue, and here's what it cost me. Like, that's a very helpful comment letter too. Or, I'm an investor and I wish that we got this disclosure. All of those types of comments and input are helpful. So I'm just going to encourage folks to, make your voices heard, reach out. We're here to listen. With that, I'll say, Jeff, thank you so much for your taking the time today. I always enjoy it when we get a chance to catch up, and I'm sure our audience has enjoyed it too.
Well, thanks for having me. Keep doing the great work you're doing. It's really making a huge difference. And so I look forward to spending more time with you.
Same.